Hey everyone, and welcome back to the channel where we dive deep into the fascinating world of hard-to-borrow stocks and potential short squeezes. Today, we're taking a microscope to a very specific, intriguing name that recently popped up on our screeners, PFSA Inc., ticker symbol PFSA. This isn't just a theoretical discussion, we're breaking down the real numbers and factors surrounding PFSA right now. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's get straight into it. PFSA Inc., trading under PFSA, operates in the cutting-edge healthcare and medical devices sector. This is a digital health technology company focused on developing bioengineered sensors for the body. Think continuous clinical-grade data transmission for personal and medical use, with their Lumi Oxygen platform designed to monitor compromised tissue, particularly for conditions like peripheral artery disease. Currently, PFSA boasts a microcap market capitalization of just $1.01 million, which immediately tells us this is a stock that can experience significant volatility on relatively low volume. Show PFSA logo and company description. What's cost to borrow and why it matters? Before we dissect PFSA's specific situation, let's quickly explain one of the most critical metrics we track, cost to borrow, or CTB. When a short seller wants to bet against a stock, they borrow shares from a broker, sell them, and hope to buy them back later at a lower price. They pay an annualized fee for the privilege of borrowing those shares, thus the cost to borrow. A high CTB is like a flashing red light. It tells you there's either immense demand from short sellers to borrow the stock, or the supply of shares available to borrow is extremely tight, or often, both. Why the stock is hard to borrow right now. Now, let's talk about PFSA. Why is it on our radar? Because its cost to borrow fee is absolutely stratospheric right now, sitting at an astounding 15.1% annualized. Highlight CTB number on screen, that's not a typo, over 1000% per year. This kind of CTB screams that borrowing PFSA shares is incredibly expensive and difficult. Fueling this tightness is an estimated float of only 0.5 million shares. A small float means fewer shares are available for trading and borrowing, making the supply-demand dynamics incredibly sensitive. While the exact number of shares currently available to borrow is unknown, a CTB over 1000% strongly implies that borrowable shares are practically non-existent. Our internal composite squeeze score for PFSA currently sits at 51.3, which indicates a moderate level of potential squeeze risk based on these and other factors. Squeeze mechanics explained. So, what does it mean when a stock is hard to borrow with such a high CTB? It sets the stage for a potential short squeeze. Here's how it works. Short sellers, who have borrowed and sold PFSA shares, are paying that eye-watering 15.1% fee every year. If the stock price starts to rise unexpectedly, those short sellers face increasing losses. Their brokers might issue margin calls, forcing them to either put up more collateral or, critically, buy back shares to close their short positions. This forced buying creates demand, which pushes the price even higher, leading to more short sellers covering, creating a snowball effect known as a short squeeze. A shrinking supply of borrowable shares, as indicated by PFSA's high CTB, means there are fewer shares for new shorts to enter or for existing shorts to reset their positions, making them even more vulnerable to an upward price movement. However, it's crucial to remember that a high cost to borrow does not guarantee a squeeze. It can also mean short sellers have very strong conviction that the price will eventually fall and are willing to pay a premium to stay short. Dilution risk check. One of the biggest killers of a short squeeze thesis is dilution. When a company issues new shares through offerings like S-1s or 424Bs, it increases the total share count, effectively diluting the value of existing shares. More importantly for short squeezes, it provides a fresh supply of shares that short sellers can use to cover their positions or even initiate new ones, completely negating the scarcity that drives a squeeze. For PFSA, we've good news on this front. Our check found no recent dilutive SEC filings in the last 90 days. Show no dilution risk graphic. This means, for now, the company hasn't added new shares to the market that could undermine a squeeze play. Recent reverse split watch. Now, for another critical piece of the PFSA puzzle. Just 7 days ago, on August 17, 2026, PFSA executed a 1-for-1 reverse stock split. For those unfamiliar, a reverse split reduces the number of outstanding shares and proportionally increases the share price. So, if you had 4 shares at $1 each after a 1-for-4 reverse split, you'd now have 1 share worth $4. This effectively reduces the total float size in terms of share count, making the stock potentially more volatile. Historically, many microcap stocks tend to see renewed volatility or even a price pop within about a month after a reverse split, as the market adjusts to the new share structure and higher price per share. While this is a frequently observed pattern in certain microcap names, it is by no means a guarantee for PFSA or any other stock. It's simply a factor that can contribute to post-split price action and an element to consider in this equation. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's look at PFSA's recent price and volume action. Today, the stock is down 17.86%. Over the last 5 days, it's seen a significant drop of 83.68%, but zoom out to the last 30 days, and PFSA is still up an impressive 123.13%. Show price chart with 1D, 5D, 30D highlighted. This shows its capacity for big moves. Today's volume, however, tells a different story. Just 279,872 shares traded, a mere 0.1% of its 30-day average volume of 2,377,625 shares. This extremely low relative volume today indicates a lack of current trading interest or significant catalysts. For a short squeeze to ignite, we typically need to see sustained buying pressure and a significant increase in volume. Given the high C2B, tiny float, and the recent reverse split potentially resetting the board, any substantial buying volume could quickly create upward pressure. The stock's ability to run up over 123% in the last 30 days, despite recent weakness, shows it can attract attention. So, PFSA presents a fascinating case study: an innovative healthcare company with an incredibly high cost to borrow, a very tight float, no immediate dilution risk, and fresh off a reverse stock split that historically can lead to renewed volatility. The low volume today, coupled with recent significant downside, offers a word of caution. It's a classic high-risk, high-reward scenario that requires careful monitoring. Remember, this is not a recommendation, but an educational exploration of the factors at play. What do you think about PFSA? Let us know your thoughts in the comments below. Don't forget to like this video, subscribe to the channel for more unique insights into hard-to-borrow stocks, and hit that notification bell so you don't miss our next deep dive.